Okay, for day two of financial literacy, I decided to focus on mortgages. So many people likely want to buy a house sometime in the future. It doesn't have to be a house, it could be an apartment, it could be a townhouse, different options. But regardless, you have to in order to do so, very few people are able to just have the cash ready and say, here's $1.5 million, give me a house. Most of us have to take what's called a mortgage out with a bank. So basically, it's a method of borrowing huge quantities of money that you'll pay off over the course of usually 25 years, which is a good chunk of anyone's life. So the first part of these notes is lots of different terminology, which I'll have you read on your own. Some things to focus on. Well, here's a down payment before you can actually buy a house. You see the bank's going to do a credit check and make sure, like, oh, do you have a stable job? Are you making stable income? What assets do you own? So assets include anything like what do you have in the bank. If you already own property, that counts as your assets too. So you might already own like $200,000 worth of property or something. Like you might have something else right there. Maybe have inheritance, but it's basically just checking sure like if you do borrow this money, do you have the means of paying it back? And of course, if you can't pay it back, what they do is they keep your down payment and basically they'll take possession of your property and then sell it to recoup any losses that they lent to you. So the principal is the starting amount, so the amount you are being loaned. So we've already looked at that term before. Amortization period, this is basically the amount of time you're going to pay off your mortgage in full. So things that get a little confusing with mortgages is there's different like time periods. First, amortization period is the total length of your mortgage. However, there's another term called the mortgage term. This is basically how much this is like a period of time. So let's say we have a amortization period of 25 years. So basically that's saying you're going to pay off your mortgage in 25 years. But usually they say, okay, you're going to have to choose a mortgage term. And that's usually less than 25 years. So how it works is saying, okay, you just started your mortgage. We're going to say it's going to take you 25 years to pay off, and we're going to lock you in at a certain value. So for the first 5 years, you're going to pay like 2% interest for the first 5 years. Okay, first 5 years, 2% interest. When those 5 years come due, there you have to renegotiate your mortgage. So this is where it can get a little risky with mortgage. So what happens if the interest rates went up? You say, oh, 5 years later, so you've been paying 2% interest for 5 years. We saw how to calculate in the previous day. After 5 years, we have to renegotiate that mortgage. But what happens if the interest rate increased? Well, you're out of luck. Interest rate's now 3%. You now have to pay 3% interest for the next 5 years, or however long you lock into. Then it comes into the third 5 year period. Maybe interest rates dropped to like 2.5. You're like, oh yeah, it dropped. I pay less. But again, each year interest rates change. You don't know what's going to happen. No one really knows what's going to happen with interest rates. It can go up. It can go down. So basically, mortgage terms, what they can do is they often give you different options. So they might say, okay, you can give you this mortgage, this 5 year term at a 5 year term for 2%, or you can lock in for 10 years, but we're going to charge you a little more. We'll charge you 2.5%. So the reason they do this is like, again, banks don't really know is it going to go up or down either. So they say, we'll lock you in for 2.5, but that means you're safe for 10 years. If that mortgage rate jumped up to 17% or something crazy, you're still paying that 2.5% for those 10 years. Of course, if it went down, you'd be like, oh darn, I'm locked into it. So basically what they'll do is like, oh, they might say, 15 years, we'll charge you like 3.5%, or for 25 years, we can lock you in at 4.5%. And the banks, they decide on those values. But if you want to guarantee that to be safe from changing interest rates, you can lock in for longer amounts of time. But again, they are going to charge you a higher rate to lock it in, because if that thing did jump up to like 10% interest rates, you are getting a huge deal for those 25 years. However, if it doesn't go up, then they're saying, most people actually just do 5-year terms. If it doesn't go up, and the bank's like, yeah, we're making extra money because we're charging you more. You're paying more than you needed to have. Again, no one knows what is going to happen. So there's some other terms that are important too. We have what's called a fixed interest rate. So fixed interest rate is that basically you agree to a deal where, again, you're locked in. So if they say 2%, you're paying 2%. Variable interest rate is kind of that more risky one. It can change. It changes with whatever rate. Usually they give you a better rate. So let's say the fixed interest rate might be 2%, but they might say, oh, your fixed option is 2%, or you can get this variable option, but we'll only charge you 1.6%. So yeah, it looks there, but again, you have no security on that one. If interest rates go up to a fixed rate of 15%, and other one's like 13%, might be that, you're paying that new 13%. It's still better than the fixed rate, but you are paying more if it goes up. But also if it goes down, then you get the better deal as well, because if it went down to like 1% interest, you might now be paying only 1.75%. So it changes with each year. What happens with interest rates? Does it go up or does it go down? So variable changes. This is just an example I found this from the Canada.ca Financial Consumer Agenda. It's this website. You can follow the link if you want to, but it gives you some different scenarios saying, okay, if you're charged 4%, and this is for a $300,000 mortgage. I think I forgot to write that down, but this is for a $300,000 mortgage. At 4%, you'd be paying $1,000 a month. After 5 years, you would have paid $63,000. The amount of interest over that 5 years is $37,000. The amount left on your mortgage is that amount. Okay, after 5 years. If this is the next one is a variable, so the fixed is very, you know what's going to happen with fixed. But saying scenario 2, what happens if you chose this variable interest rate, which is 3.5, but over those 5 years, interest rates increased. Right? Interest rate went up. Interest rates went up. It went from 3.5 to 5.5. So yes, it started less, $9.99. But each successive year got more expensive. So because this person did a variable and it went up, they ended up paying an extra $3,000. Again, this is a really bad scenario if it went up a total of 4%. You're going from $9.99 to $1,400. You're paying an extra like almost 10 grand more because you just guessed wrong. However, the best case scenario is if you choose a variable, you get a better rate, but if it stays low or goes lower, you save money. So notice how the person saved around $3,000 by going with the variable. But again, if it goes up, you could be in trouble. Because it depends on what your disposable income is. Like how much can you pull from if you need to end up paying more. Some other terms too. The overall equation for mortgages is quite complicated because what's happening with mortgage is not always just simply adding it to a value. When you pay some money to mortgage, your mortgage essentially gets smaller. So with each payment, your mortgage owed gets smaller and smaller and smaller and smaller. However, they tell you you're always paying the same fixed amount. So as your mortgage gets smaller and smaller and smaller, more of the money you pay is going to actually paying it off, less to interest. We'll do an example in the next video, and so instead of using this formula, we can actually go to Real Estate Weekly, and they have a mortgage calculator for us, so we're just going to use that. There might be other mortgage calculators out there, but this is the one I found is pretty easy to use. So in the next video, we'll go over how to use that.